So we matched the record of the best streak to begin a year. It's almost like we're starting a new sports season, and the S&P has won 6 games in a row, and it's the best start they've ever had to a season. Now, for some of your favorite sports teams that have had really good starts like that, Golden State, 24 game win streak. They didn't quite win the championship that year, but they had a good year. In fact, set the record for the most wins that year. Those seasons tend to be good seasons when your teams have really record-setting starts to their seasons. So that seems to be the case right now for the stock market. I'm going to break down what this streak means in terms of like our expectations for near-term moves and how to handle that. And I'm also going to look at some major themes from an intermarket relationship that are playing out and how that impacts a trade idea. So that's where our trade idea comes from. So let's go ahead and get started. Today is Tuesday, January the 9th, 2018. This is the Market Outlook video from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. I've been getting some emails and comments from people that have found us that have watched for the first time. Let me know if you're here. We appreciate having you and keep coming back for more. Subscribe to my YouTube channel by clicking that red subscribe button right down there below the video. You can do that right now while you're watching. Also, while you're there, hit the thumbs up icon. That lets me know that you like the video, that you want me to do it again tomorrow. It's a really one-click, easy way to give me feedback. It lets me know what you're thinking. Scroll down further. Comment on anything that stands out to you from this video. What did you learn? Something maybe that you already knew that you hadn't thought about for a while. Finally, in the description of this YouTube video, there's a bunch of links in there. Join or subscribe to my daily email Market Outlook newsletter that I send out every day. Click on that link where you can get time-stamped hyperlink summaries of all the segments that we talk about in the video, as well as daily lists in the S&P 500 of clusters from the market forecast indicator. Follow me on Twitter for more content in addition to these videos. You'll see my handle on the screen at DavidSettle42. You'll also see the Market Scholars handle as well. Make sure you're following that account, as well as my business partner account, Brandon Van Zee. Obviously, his Twitter handle is at Brandon Van Zee. Pinned to the top of my timeline is today's Market Outlook video. Make sure you like and retweet that tweet there. Also, join the Market Outlook Facebook community. You'll see the link, the address at the top of the page. There's also a link to it that will take you directly there in the description of the video down below. All right, well, let's take a look at the S&P 500 first, as we always do, with the market forecast indicator. So again, we had an update, and obviously, what was it? I think we've had like, if I remember correct counting, I did this earlier this morning. I believe we've had like 8 days in a row of gaps on, let's take a look at the SPY and take a look at the intraday chart here, including today. So yesterday was not a gap higher. That was the one outlier. But aside from that, 1, 2, 3, 4, 5, 6, 7, 8 gaps in a row. And 8 gaps out of 9 days. Yesterday being the only one that we didn't get a gap, and that's 26 was the last day before then that we didn't get a gap higher. So that means every other day we start the market up high. In fact, for most of this time, you can see the low of the day on the last day of the year was at the end of the day. But before that, the low of the day was at the open. Low of the day at the open, 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 low of the day pretty much at the open. We came closer to it by the end of the day, but you can see, we've had, that's a strong bullish posture there. We continue to maintain on the S&P 500. Near-term line is still easily entrenched in that reversal zone. A little bit of a long upper shadow. Now, again, it doesn't have to be too long, but you see every time we have some turnover, there's some long upper shadows there. That's when you start to get a little concerned about this near-term run. The intermediate run's been going on. That's the green Fibonacci lines, measures the length of the intermediate run off of the orange oval low point. Last time the intermediate line was below 50. The market sentiment run, the last time the market sentiment got below 50 was at the election over here. So this market sentiment run has been lasting, for over a year here, and you can see, where some pullbacks will be on a lot of these runs. You can see here that that where the near-term levels of support will be, and if we happen to pull all the way back on this near-term run that we've had, you can see where the ovals are, and this would be the next red oval here. But if we happen to pull through all that support back there, that also happens to be the 23% Fibonacci retracement of this intermediate run, which you'll start to find some support in that area. Now that might not happen in the first near-term drop. It might take a drop to these Fibonacci supports, a bearish near-term high, and then a break to a new lower low to get down to here. And again, what the chatter has always been from these market outlook videos is, the trend is bullish, and if we do get any kind of pullback, and when we do get any kind of pullback, it will most likely be choppy up in the higher part of the range. Like I mentioned before on Twitter, here I brought this up earlier today. That where was it? Right here. You don't ever short markets when they're pushing the upper band up, and we're trading in the top half of the range. As you can see, it just keeps pushing up, and then it gets wide, and we typically don't drop from a wide 4-week range, from the top of a wide 4-week range to the bottom of it, in a matter of days. Usually we kind of grind in this upper half, while the lower end starts to move up higher, and then the midpoint gets higher too, and then that's when it gets into the lower half of the chart, usually from a tighter range. Then okay, things can get more bearish. The intermediate line might actually drop below 50 and form a new intermediate low point, which will most likely be a lot higher than the last intermediate low point that we had. So the posture continues to the posture continues to be bullish. The long-term trend obviously is still easily above 80. So we're obviously on a strong bullish trend, and we don't break from these levels. And even there was a great tweet out there that said, this could be setting up for something like 1987, which again, it's kind of hard to argue that something like that might not occur because of just how extreme this move has been to the upside. But just remember, in 1987, now the data here we didn't have all the data, and you can see the kind of run that we had. Get back to there. You can see the kind of run that we had heading into, and even 1986 was a good run, and so was 1985. And there's your October, Black Monday there, right there. So it was the 16th. So on the 19th is when it dropped so sharply. But again, you can see that heading into that run, we had already dropped below the 6-week moving average. We had formed, the posture had been below, the intermediate line had been below 50 for most of September. We did try to come up to a new higher high, but that didn't work. You can see right here that the intermediate line, the momentum line got up to the upper part, the near-term line got up there, but then we rolled over, and the intermediate line rolled back over. And you can see in early October, the intermediate line was strongly bearish, was getting more and more bearish, and we had broken below. We had that near-term divergence there. We had broken below 310 already, below these low points on October the 14th. And then again on October 15th, it broke below some more. And then, of course, the 16th was a down day. So you notice this drop didn't occur when the stocks were up, when the S&P was up here. It was, a month later coming off of the high. So, we will get, most likely, nothing's guaranteed, right? But most likely we will get some kind of warning before things really, if things ever were to drop sharply before they did, we'll get plenty of warning, especially if you're watching these videos every day, because we'll look at these charts. Now you look at the Dow Jones, and you can see strongly bullish, momentum lines down, but not to an extreme low, long-term market sentiment, new all-time highs. You take a look at the NASDAQ composite, same thing here. New all-time highs, 6 days in a row. The last time we started the year, 6 days in a row to the upside is 1999. Most of you know that ended up being a very good year. Now, just for some perspective, let's go back to the beginning. Let's go back to 1999, so right there. And we'll take a look at that yearly chart. So there is the beginning of 1999 here, and you can see, the 6 days in a row to the upside, followed by some downward moves. But from that point, look at how the rest of the year did, even into the beginning of 2000. So 6 days in a row has traditionally, doesn't happen very often, and it hasn't been ever 7 days in a row for this or the S&P. But traditionally, that's a bullish sign for stocks. So for the year, for the whole year. Now, granted, who knows what's going to happen, and we'll see it, and we'll react accordingly as things happen day by day. But it's a solid start to the year here. And then finally, the Russell 2000. I'll take a look at that one on a one-year chart. Remember how the Russell 2000 was just barely trying to get up above that high of resistance? It did a little bit yesterday, and it's a one whole point above it today. So it's not quite breaking out above that high of that long upper shadow, and we're coming off of a bearish cluster with things starting to roll over to the downside. So again, the trends are strongly bullish. We can't deny those, but they're mature, which means we'll get more near-term ups and downs. We've had a good strong near-term up. Expect a decent near-term move down. Not significant, not extreme, but a decent move down according to what the move we've seen to the upside. And we'll get some more near-term ups and downs until that posture pulls back and we get another opportunity for a solid bounce higher. And volatility rises and gives us the opportunity to fade it back down to lower levels. Even if we were to take a look at the long-term chart, going back again to that 1987 period, and you could also look at 1998 too. That the drop that we had there, we'll take a look at that as well. But you can see, 1987 we had a period 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks out of 13 to the upside. But you can see all the arrows that we got before things really hit the fan. And of course, on a daily chart, we can see when we drop below 310. So that was 1987. If I were to now look over to 1998, when we also had a similar sharp increase in volatility from very high levels. So here's that move. Here's the move that preceded that. But you can see before that move, we had this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 out of 12-week win streak. That got us moving sideways. Produced some arrows. We came down, tested the 200-day moving average with a divergence, no less. Tested that 200-day moving average, and that's when things really hit the fan in 1998. You can see, if I were to take a look at it on a daily chart, when things were the whole long-term capital management. One second here. Takes a while to load up all those daily prices. There we go. So there's the daily chart in 1998. And again, you can see plenty of warning before things really got crazy, right? Over here. We had dropped below lows. We had bounced up and formed lower high points. So, we're not going to get an extreme move to the downside. An extreme move to the downside from these levels. Usually, according to what we've seen in the past, there is plenty of warning as we trade around in that 4-week range. And again, look at the week that was really since the middle of August. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, now 17 this week out of 21 in a row. That's a strong move higher. It's a little similar to what we had over here. A few more down weeks in there in the sideways action before we got some volatility, and that wasn't anything to write home about. When you look at the 3 green arrow charts, of course, just like yesterday, continue to be very, very high. MACD is very high, higher than it's been on an absolute basis in the last 52 weeks. So Stochastics really can't get much higher, and came down a little bit because now we didn't close at a high today. So the more upper shadows we get, the more the Stochastics will move to the downside, or at least the more times that we close nearer the low. We've been closing near the highs all these days. That's what's pushed it up so high. Today we didn't close at the high. So, we'll see how that tomorrow, and considering we're so far up above even the 8-day moving average, highly unlikely we're going to be able to continue with what we've seen in the past 6 days going forward here without at least a near-term pullback. All right, if you take a look at the intraday move, you can see we did get above this old 4-week high point. There's the near term. We can take that line off. That's the near term move. But you can see, again, another move higher to the 4-week high. And again, like I said, until you break down into the lower half of this 4-week range, which now between 275 and 264 and a half, you're looking at about 270, or in this area right here. This is the midway point. You have to break below 268.50 before you even start to worry about any significant move to the downside. And so there's this. I hear so much about this market can't do what it's doing. It's at the top end of a 4-week range. It's breaking above those highs every day. Yes, this is crazy, but the technical setup does not even come close to being aggressively bearish. Yes, we can add some bearishness, some bearish trades to our portfolio. We talked about one last night, but not a lot and not big positions, right? Just a little bit to help take a little bit of risk off to any kind of continued upside move, because the odds of the more we go higher, the odds we keep going higher get smaller and smaller, but not to zero, as you can see every day this week. So we're not anywhere close to the lower band, the lower edge of the 4-week range, much less the lower half of the range, and that's when you start looking to be more bearish than just using it to balance your active trading portfolio. But today's move, again, higher high. Unlike the last so many days, though, we didn't close at the high. So we were actually close a little bit, about in the middle of the range, but a little bit closer to the low, and even the after hours are trading a little bit lower. But a higher high, higher low nonetheless, closing above yesterday's high, closing above last week's high, and above the 4-week high. So a bearish candle all the way around, or bullish candle, all the way around. The range was a little, big, 1.16 points. The gap, you can see we closed 273.92, the low at 274, so just a smidgen. So we're looking at maybe 1.25 points when you include the gap today. There's that long upper shadow again. Volume, like yesterday, 57 million. So put that into context here. 1.25 points is below the line. 50 some odd million is also below the line. Those are good numbers to maintain the bullish trend. We want these lines to keep coming down. That will help us to stay more and more bullish. From a volatility standpoint, you can see how we got up above 10 today. It continues to move higher. It hasn't crossed above 10.5, which is kind of the last peak that we've had in volatility. The last few times we've come from these low levels. But we are slowly moving higher here. Nothing too bearish, but we are moving higher. In fact, one of the things I tweeted out too was that we don't get days where the S&P hits all-time high, VIX goes up, and there was more decliners by a certain percentage, if I remember correctly, than there were advancers. I'll find that here in a second. But you can see too, if we were to take a look at the here it is, the VIX relative to VXV, so which is the 3-month volatility, 30 days versus 3 months, then you'll see, hey, we got back above 80. So again, not overly bearish, but rising. So, you can see how things are setting up for, some kind of near-term pullback. Now, I know it doesn't seem that way because every day is an up day, but you can see how it's not all bullish across all these other technical indicators, and some of them that are just so extreme that, again, there will be a pullback at some point in time. Nothing ever goes up forever. But we don't want to anticipate pullbacks and make significantly bearish trades because of it. We can reduce risk when there is higher risk of pullbacks, but we don't necessarily trade aggressive to the downside. And like I said, that before, that was something I tweeted out. You all should know that we don't trade bearish, significantly bearish trades when we're trading at the top end of a 4-week range. I tweeted that out there. But there's a tweet there. When the S&P closes at a 52-week high, the VIX rises, and there are at least 25% more decliners than advancers on stocks in the S&P 500. Today has been the only day that's ever happened, supposedly, according to at least that person there, and you can see there's a lot of interaction with that. But we don't get these kind of moves typically. Now, and this, the other thought is, that I wanted to point out too. And again, remember, to get this stuff that I'm putting out there, make sure you follow me. Again, there's the address, twitter.com/DavidSettle42. You come over here, there'll be a follow button right there. Make sure you're liking, retweeting these things as you see them, because the more you engage with my tweets, the more Twitter will say, hey, I'll keep pushing them David Settle's tweets, because they like them and they retweet them. And that's, again, liking this one at the top, engaging. There's always one pin at the top that you can engage with. That's always going to be tonight's Market Outlook video. And we have the goal of hitting 100 likes sometime this week. We got close with last night's video. Got all the way up to 94. So I appreciate that. Let's see if we can keep going to 100 again. A like there means will tell Twitter to keep pushing you my stuff. It also tells me that you liked it and you want me to do it again. So one click, really easy way to do that. There's a link in the description of the YouTube video down below that will take you straight to this tweet, so you can like it, so you can do it quicker without having to type it in. All right, but this is the other point I wanted to bring up. So here's the crash of 1987, a chart of 1987 here. That was Black Monday right there, and you can see the gap there. But you can also see we didn't drop from all-time highs. Now, we had a good run to get there, to get to those all-time highs that year, but you see how we had dropped down below the 6-week moving average. We had formed a lower high, came back down and retested those lows at 310, broke below those lows with a bearish near-term divergence. You can see the intermediate posture was bearish all of September. There are a lot of extreme lows in the momentum line and bearish lows in the near-term line. So you notice, we had some warning, and we even had a warning the couple of days prior, dropping below 300, easily breaking below this the 310, 300, and then even all the way down to 280. Now there, might have been some people buying there thinking we're going to hit support and bounce, but that next weekend, we dropped significantly, and of course that was the low point that we set, and away it went to the upside, producing long lower shadows on the weekly chart, which are typically bullish, so with support at those lower shadows. Needless to say, we had plenty of warning before things really hit the fan. And the same thing in 2007, 2008, if I were to go back to that 2007-2008 period of time, we'll take a look at it here. Remember, again, things really hit the fan in 2008. Those 2 weeks right there. That was the week I was in Yellowstone National Park. I think actually it might have been this week. And things were just dropping like crazy, day after day after day after day. But you notice, to get to that point where things were the worst, I mean, in 2 weeks we went from 1,200 down to 900. That's what? A loss of 300 points. That's almost a 30% drop in 2 weeks. Significant drop, all the way to 850 at one point in time. But look how bearish we were. I mean, we were on a pretty significant bearish trend from 1550 down to 1250 before that drop. So we will have plenty of warning before there's something significant. Yes, we are going crazily higher right now. Yes, it's setting up for usually the bigger the inhales, the bigger the exhales will be. So yes, there's all sorts of possibility of that, but it's not going to happen out of the blue. And it's not going to happen from all-time highs, at least according to past precedent. There will always be some weakness that will develop ahead of something like that. And as you watch these videos day by day, we'll talk about how that weakness develops. So we'll know to prepare for, those kind of fall off the cliff type moves. Now, in terms of what's driving the price action here, you can see that over here that we didn't. The only thing that really came out was the JOLTS number. That's the openings, job openings, layoffs, turnover. Kind of a minor employment indicator, but important to the Fed. And we're pulling back a little bit in terms of job openings. When job openings rises, typically is good for the job market because people are moving and wages are rising to attract new employees. So a little bit of a downturn, but we've seen a little bit of downturn, a lot. So nothing to worry about until you break that trend, right? So, and you can see that hasn't really made a dent in this really, really strong economic surprise index, which is at up above 80, really high levels, and really didn't alter maybe a little bit of a drop in Fed funds expectations. If you take a look at the major asset classes and how they performed today, you can see we're kind of back to crude oil being re-engaging its strength there, even with the dollar kind of moving up a little bit today. You can see kind of breaking back up above at the upper Bollinger Band, still pushing the way higher there. If we take a look at the weekly chart with the 50 and 200-day moving averages, here, let's go a little bit further so we can see some perspective on this. We'll go 10 years on the weekly chart. So you can see how we're above that 50-day moving average. It's continuing to rise. You can see where there's going to be some resistance here, a little bit of resistance at 75, more resistance at 80. That's going to be more of a level that we can hit. That's $17 up from where we're at right now. So there's potential for crude oil and also energy stocks. We talked about the potential for them to have a good 2018. Now, will that happen week after week, up, 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 up? Who knows? There'll probably be some pullbacks along the way, but you can see where some price targets would be based on reading the charts of where energy can get to and the impact that can have. On the other end of things, yields, bond prices were the other big mover to the downside. If you take a look at bond yields, making a big jump above 2.5%. We've got up to 2.6% twice since the election. So, right, since the election, we had the big spike higher because Make America Great Again, right, in terms of all of our financial markets too. So the markets really moved higher, but then some of the ideas for fiscal accommodation didn't get a lot of traction right off the bat, and they really started to gain more traction here later, especially the tax reform. And of course, passing here late, that's helped push yields higher. And so if we get to this 2.6% and move higher, then 3% becomes, and 3% is where we got to during QE3. So QE3 started at the end of 2012, ran all the way through 2013, and then started to taper in 2014, tapering being kind of a restrictive monetary policy because you're being so accommodative here. And again, all that accommodation raising up the prospects for higher inflation. And you can see even, QE2, when QE2 came out, and then the rates jumped up to 3.5% before it ended. When QE1 came out, rates jumped up to 3.75%. So this is the 10-year note. So when we're getting this accommodation, first from a monetary standpoint, and then now from a fiscal standpoint, there's precedent for yield to get up to 3, 3.5, 3.75, up to close to 4% on these moves, and we're at 2.5. So of course, that's going to have an impact on things. And if you take a look at something like TLT, which measures long-term bonds, here's the weekly chart, mind you, and you can see a little bit of a head and shoulders pattern developing here on this half a year. But if you go out even further, a big time head and shoulders pattern developing with a break now so far this week below the 200-day moving average. So in 2018, especially with the 50-day being so close to the 200-day, is setting up for a potential move, potential significant move to the downside. It's interesting to see the sector rotation. So again, bonds dropped, and that's going to bring utilities and real estate down. If that continues, if we talked about, if bonds ends up having a bad 2018 with some of these long-term price patterns playing out, then there's going to be some underperformance in utilities and real estate. And those, all the bullish, all the oversold clusters in today's newsletter, email that I send out to all the email subscribers, pretty much were all in the real estate sector. And we've seen utilities, if you take a look at utilities here on the long-term chart, we'll put up XLU here, utilities is the only one that is currently below 2 standard deviations linear regression to the downside on the 1-year chart. Now, if you take a look at a little bit longer term view, there's still some more room to go before you hit the 5-year linear regression. So we're just breaking below into the lower half of this range. So there's more potential. See, unlike something like SPY, which is above its 5-year. It's right at or just a little smidgen above. Here, let's hide those drawn items. Just a smidgen above its 5-year and its 1-year. 1-year linear regression. There we go, with a long upper shadow. And then you can see the 10-year getting above the first standard deviation, which is significant for monthly. You can see monthly has got a tighter range typically. So that's quite the range. That's a big, long winning streak without any downward moves on the 10-year. So XLU is a little different in that regard, in that it's not, it is down below its 2 standard deviations on this 1-year, but according to, the 5-year, it's not below its 2 standard deviations, and it's not even below the linear regression line on the 10-year. So there's potential for XLU to show some serious underperformance if bonds also makes a significant drop to the downside, which we're expecting based on those price patterns. Whether it actually, whether it actually plays out or not, they haven't broken those patterns yet. But TLT, here we go, TLT is breaking below its 200-day moving average. So we'll see if that break holds and eventually the 50-day comes below, and we'll have a more significant move that's got a little bit more staying power. So that's how the sector, those continue to be dropping. Staples are also lagging behind, and financials are lagging behind despite the big move up. In fact, if you look at today with yields going up, financials started the day pretty strong. But once, we kind of hit that peak, kind of in the middle of the day when the S&P and healthcare kind of hit that peak early on, there was some weakness here eventually. Financials kind of came down while the market came down from that mid-morning kind of Europe close, that high point. Healthcare, discretionary industrials led, materials moving to the downside along with technology. So by the end of the day, the biggest laggards behind, of course, are the 2 interest rate sensitive areas. But you can see energy, materials giving up some gains. So nothing significant, but giving up some gains. Technology giving up some gains. That's been a momentum sector here. And then, of course, healthcare kind of bouncing back. Healthcare had been weaker, and it's really kind of made a bounce back move here today. We focused on that healthcare sector yesterday with a bearish trade opportunity. And even though the sector itself bounced up, we can see here that the stock that we were looking at continued, did bounce up too, but then continued down and broke below and closed below yesterday's low point. So it continues to move low. There was some bearish opportunities. So not all healthcare bounced up today. But you can see which sectors, again, energy, materials, and technology, despite their pullbacks, they only pulled back not because the market's all of a sudden bearish in those areas, but because of they're just taking profits. So, watch for that pullback. That might lead to a broader pullback in the broader market, that near-term pullback that we're expecting. And if we were to bounce back up off a new near-term low, you would still expect those sectors that have been performing the best over the last 2 weeks. In fact, since the during this winning streak, this 6-day winning streak, those have been the biggest winners consistently throughout the whole 3 weeks. So they pull back. This is profit taking. When we get the next near-term bounce, we expect that those would be the ones that would continue to bounce higher, along with industrials and consumer discretionary too. All right, so for today's trade idea, one of the major moves is that move higher in crude oil. That can impact these airline stocks that have been doing really, really well lately. But if crude oil, if their input prices move higher, that can impact their profit potential. And you can see in the last couple of days, we've had a couple in anticipation of earnings. We've had a couple of significant downward moves with some pretty decent volume. In fact, you have 3 red arrows right now. Now, normally I would look at that, 3 red arrows on an upward trend, especially coming off of highs, and say, okay, I'm going to speculate when I bounce. Because a lot of times on upward trends, when you get 3 red arrows, we bounce off of that and move up higher. Now, that didn't happen over here. We actually went down to 45. In fact, if you look at the Bollinger Bands, we hit that upper Bollinger Bands on a weekly chart, mind you, so it's a long-term chart, and we came down to the lower band. And you can see it has a history of pushing up to the upper band, coming down to the lower band, pushing up to the upper band, coming down through to the lower band. So, here we've moved up to the upper band. Are we now starting to drop back down to the lower band? See, that one didn't get to the lower band, but didn't get to the upper band beforehand either. So, is that what we're seeing? And so we can say, okay, well, we do have earnings, so whatever we do, we don't want to be too aggressively bullish. Also, the other thing to look at, too, is the MACD is coming down, but the stochastics already dropping below 50, so MACD is dropping close to dropping below 0. Looking at the market forecast, it looks like it has dropped a little bit below 80. So, again, don't want to be aggressively bearish on this because it's got a weak bearish posture. So, not a normal position size, smaller position size. The near-term line falling here lower than it has since we were bearish in that period of time. So I don't want to be aggressively bearish. If I look to buy a put, I can buy, an at-the-money put here, roughly at the money, this 54 put. That's 45 days out. I can buy that for $1.92, but then I can come over here and sell the 51 to relieve some of that cost. So now I'm selling the 51 for 75. Midpoint's right about 80 cents. Buying this one for somewhere in between here, close to 192. So I get right now, if I were to get right in the midpoint in between, I'd end up paying $1.06. So it's probably going to be somewhere, around this $1.10, $1.11. And you notice here, let's move this up a little bit more. If we do end up getting around that price, here's my odds of success. You can see with the volatility as high as it is right now, with that earnings that you have, and there's no very, very little exposure to Vega risk. So if volatility were to plummet, that'd be okay, but it doesn't really bother us too much. You can see the stock has got potential to move here to 48, 40, a little bit under 49. So if you take a look at it on this chart, here is, let's go back to a daily chart. Here is 49, so down, just below 49 would be all the way back down, essentially to these lows, and we get maximum gain if it drops below 51, which is right here. And if we get maximum gain, we'll get roughly $200, $189 for $100 of risk. So depending upon where you get filled in, roughly a 2-to-1 profit to loss ratio with very little minimal exposure to theta time decay. Which typically on a put, you're negative theta, so you're getting hit by negative theta day by day as you're waiting for the stock to move. And with that earnings announcement coming out, volatility can change rapidly, so we're not very affected by that either. So that's, again, a way to do a bearish trade, limiting the risk. So I only have a negative 24 delta instead of a negative 50 delta, which is what I'd have if I buy it at the money, or was it 47, I believe. Now if the stock goes up $1, I only lose half of what I would if I had just bought the put by itself, because I got that short put here at 51. So it's it's a long put vertical, but it's a way to do a bearish trade, reducing risk, limiting time decay, and reducing exposure to volatility changes. I do cap my gains. If this thing plummeted, I'm not going to make anything more. That's the downside of this. But we just have to weigh what's more important for us in this particular trade. With that earnings coming up and the fact that the market's still strongly bullish, I don't want to be aggressively. I don't want to be aggressively bearish. I just want to have something that is a little bit of bearish that'll make my active trading portfolio not so one-sided in the direction of the trend right now, especially if there's more and more weakness coming, potentially coming here in the near future. So in summary, it's been a record-setting, record-matching day today on the S&P 500. Tomorrow could be a record-breaking, a record-setting day if we get 7 days in a row. Obviously, markets don't go up forever. We can't fight the trend, but we can manage risk as risk increases. The more and more we get days like today, we've only seen a couple of times. We've only had 6-day streaks like this a couple of other times. 1999, 1964. I tweeted that out on my timeline. Those happen to be very good years for the markets. They also started the year with 6-day streaks. NASDAQ for 99, S&P for 64. So we're not looking for, we're looking for a good year. A lot of things are telling us to look for a good year in 2018. Doesn't guarantee anything, but that's what we're expecting. But when you get such moves, such extreme one-sided moves like this, at some point in time, every time you inhale and the deeper you inhale, you got to exhale. So we can't, anticipate an exhale and then trade in that direction, but we can definitely manage risk and look for balance as we anticipate that kind of pullback. So, as always, thanks again for watching tonight. Remember to subscribe, like, and comment down below. Great comments, great interaction. I appreciate all the thumbs ups we're like over 200 on every video. So, really appreciate that. Let me know that you liked it, that you want me to do it again. Remember to follow me on Twitter to get some of this content I've been pointing out today. Even if you're not a Twitter person, if you want to stay in tune with the markets, might be a good time to get up an account there. Follow me, follow Brandon, follow our Market Scholars account. I can give you others that you can follow as well. And remember also to join our Facebook group, the Market Outlook community. We're getting up to closer and closer to 800 people, so join that community group as well. Have a great evening, everybody. We'll see you all tomorrow.